Financial management, December 2024, question 22. December 2024, question 22. So Mustard Limited is planning to launch a new product branded Malinex beginning January 2025. So beginning January 2025. The following data relates to the launch of the project. We have here end of 2024. This is end of 2024, year zero. The initial investment is 500,000. So these are the annual project duration periods. Resale value. Resale value. Where is the resale value? 70. Production and sale quantities in units can also be seen. Selling price per unit, variable cost per unit, total fixed cost, and also depreciation. Additional information. Corporation tax will be charged at the rate of 30% and is paid annually at the end of the same year when earned. Tax will also apply on the disposal of the machine at the end of the project's life. Depreciation is same as capital allowances. So working capital of 20 million will be required at the beginning of the project. This will increase at 5 million for each of the 4 years and then released at the end of the project's life in 2029. Required, compute the return on investment of the project, compute the project after tax cash flows over the 5 years, plot a graph of the project net present value profile given the weighted average cost ranging from 1% to 15%, determine the project's IRR, compute the PI at 10% weighted average cost of capital. So that is the total of 20 marks in this sitting. Solution. Can also get to solution. Solution for this question. Now, for you to get the first part, computing the return on investment is cash flows after tax. We are going to get cash flows over, that will be like profit after tax. Or the return on investment will be the cash flows, then over initial investment. So it means for us to get this, then we need to be doing the first one first. For us to get this, then we need the project cash flows, after tax cash flows. Project after tax cash flows. So workings, and the first thing is relevant cash flows. Let us start with relevant cash flows. Relevant cash flows. The relevant cash flows. The first cash flow is initial cash outlay. Initial cash outlay. Initial cash outlay. Now for initial cash outlay, we have the initial investment of 500,000. So initial investment. The initial investment has been given as equal sign, then you click on 500,000. 500,000. Now from initial investment, that is the one that is depreciable. There was investment in working capital. Where is the investment in working capital? Number 3. Working capital will be required at the beginning of the project of 20 million. So this is 20 million. 20 million. So working capital, 20 million. 20 million. Now remember, the first one here is the one that is depreciable. We are going to say depreciable, close bracket. Depreciable. Total initial outlay, sum up the two. For total initial, from initial cash outlay, Now second one is investment in working capital. The investment in working capital. Investment in working capital. Now for the investment in working capital, we have year and injection stroke recovery. The years given are from 2024. So we have 2024. Then add 1, because you are moving to so many other years, 2024 all the way to 2027, 2029, up to 2029. To additional information number 3, working capital of 20 million will be required at the beginning of the project, that is 2024. This will increase at 5 million for each of the next 4 years and then released at the end of the project. So it will be increasing by 5, 5, 5, 5, 5. So the first year is 20,000. Then the other years it will be 5, 5, 5, 5. Then it will be recovered. Remember, all these are inflows. I forgot to mention that all those are inflows. So it will be equal sign negative because they are inflows. So equal sign, then negative. This one should also be equal sign negative. They are outflows, I mean, not inflows. Equal sign negative. Then the entire amount will be reversed at the end of the project. That will be in 2029. They said it here. This will increase at 5 million for each of the 4 years and then released at the end of the project. So released at the end of the project will be equal sign sum, then equal sign negative.
Mwalimu, I have a question.
So that is 20, then 5, 5, 5, 5, then equal sign negative sum. When it's being recovered, you just sum all this up to 2028, close bracket and enter. 40,000 will be recovered. The next item will be salvage value.
Mwalimu.
Salvage. Yeah, the other part will be salvage value. Salvage value is the same as resale. Resale value and tax saving or tax, okay, salvage value and what? Tax saving or something like that. You can just talk about salvage value then. Salvage or resale value. Or maybe profit, gain on sale on the item. So what is the resale value? The resale value is given as 70. Less net book value, less the net book value. Start with cost. Now the cost which was depreciable is 500. Accumulated depreciation. Accumulated depreciation is given here. So the accumulated depreciation is 150, 105, 75, 50, and 35. So depreciation equal sign a negative summation of. So equal sign negative sum, then sum everything from 150 to 35. Close bracket, enter. that is 415. So book value sum of these two, 85. Let me negate because we want to deduct that, so equal sign negative. We can just add those two. So it's 85,000. That is the net book value. Loss on resale. Now the loss on resale will be 70 plus 85, which is 15. So go for the tax rate. Tax rate has been given as 30% in note 1. Tax rate is 30%. So tax rate 30%. Now if it's a loss, then that is a tax saving. Tax saving on loss on sale of asset. Tax saving on sale on loss on resale. The saving will be equal sign the 15 times negative 30, because it's a saving, it's an inflow. So a saving is a gain, that's an inflow, so you make it to be a positive figure, and it will be 4,500 of the question. So we now answer part B of the question. Before answering the return on investment, we compute the after-tax cash flows over the 5 years. So we'll be having the years. The years are from 2025, so equal sign, then click on the 2025, drag across. Those are our years. Then we have our details. Details, years. Start with the selling price, not selling price, but production quantities. Production and sales quantities. So production and sales quantities. Production and sell quantities. So quantity sold, truncate that to thousands. Because everything has been truncated, I also want you to truncate that to thousands. So it's truncated to thousands. Equal sign. These are not truncated. These are not truncated. So you can see 60,000 in full. It's not truncated while everything else is truncated. So this will be 60,000 divided by 1,000. So 60,000 divided by 1,000. Enter. Drag across. So you just divide with 1,000. Equal sign. Click on selling price per unit. You'll click on the selling price per unit. Then equal sign, give me that selling price per unit, which is 5,000. 5,000, drag across. That was the selling price per unit. Drag down, because the other one that follows is variable cost per unit. Then just drag across, or just drag this down as well. and I want you to negate it. So equal sign negative and drag across. Same as what we have here. We've picked the 3,200, 3,000, 3,200, 34, 36, and 38. That's the variable cost per unit. Contribution per unit, multiply times the units. So contribution per unit times the units will be equal sign 2,000 times 60. 2,000 times 60 to get 120,000, drag across. I hope there is no other per unit here. Yeah, there is no any other per unit. There is no any other per unit. You can see this is now total fixed cost. Then we have also depreciation. So total fixed costs, the total fixed costs, $15,000. Negate it so that it can come as a negative figure. So equal sign negative, let it arrive as a negative figure, then drag across. We also have depreciation, equal sign negative, pick the depreciation, enter, drag across for depreciation. Then profit before tax. Select and alt equal. Select from the total contribution, sum the two, because the other expenses are negatives, you just sum, then drag across. Expense at 30%. Do we tax losses? Charles, do we tax losses?
No,
We tax. In FM,
we don't.
we don't. So you can use the if statement. Equal sign, you know how to do the if statement. If statement, equal sign, if tab. If this cell, this one, is greater than 0, comma, take that cell and multiply with negative 30%. Otherwise, the answer is 0. Remember, we did if statement some time back. And enter. Drag across, and you have your amounts. Profit after tax. Profit after tax. Alt equal, because you are adding 45 and add with the tax, that remains 45. Then drag across. That becomes our profit after tax. Add back depreciation. The purpose of depreciation is to provide a tax shield effect. Now that we've already gotten the tax shield effect, then we simply add back depreciation. So that will be equal sign 45, add this 0. Nope. Where is depreciation? It will be the profit after tax plus depreciation. You add back depreciation. Now depreciation appears as a negative, so do we less? Yeah, so we less with this, that we can add back depreciation. Is that correct? So you less, because the negative will cancel the other negative, and therefore you are adding. 105. So on the add back depreciation, then drag across. Add back, I think I'm doing add back depreciation, and that will be just say equal sign. So add back depreciation will be equal sign negative, then click on the depreciation. So equal sign, negative, then click on the depreciation, the one that we are adding back, it's now positive this way. So you add back the depreciation. So we bring that depreciation, then now cash flow will be here. Cash flows will be here. Now cash flows will be equal sign, the profit after tax plus the depreciation. Plus the depreciation, and the answer is 105, though the same as the other one, but we had skipped a step. There are some adjustments to be made. One are adjustments that I want us to make on this. One, injection stroke recovery of working capital. Injection or recovery of working capital. So in the first year of 2025, it was equal sign, move up, 5,000. It's an injection, so it's an outflow. Then just copy across. In the last year, in the last period, it will be an inflow. You can see the recovery of 40,000. So injection stroke recovery of working cap. Then resale value, resale stroke salvage value. Resale, that is in the last year. The resale value is 70 in the last year. Resale value is 70, 2029. Tax saving on resale, on gain, on loss on resale. Tax saving on loss on resale. The tax saving on the loss on resale is also given as 4,500. So the tax saving is an inflow in the 2029 year. Tax saving on loss on resale. Finally, we will get our final adjusted cash flows. This will then give you adjusted cash flows. Adjusted cash flows. Alt equal, you sum from the cash flows that we have up there. Enter, drag across. So that becomes the cash flows over the period. Now that answers part B. That just answers part B, compute the project after tax cash flows over the 5 years. Part A, compute the return on investment of the project. So return on investment of the project. Return on investment of the project. Return on investment, ROI. Now ROI, the return on investment, will be obtained as follows. So the return on investment will be adjusted cash flows minus initial outlay over initial outlay. Five marks. Somebody gave it 5 marks. Now adjusted cash flows, then initial outlay is at the top. So initial outlay is here, total initial outlay. Adjusted cash flows will be the summation of all this, the adjusted cash flows. Sum. Then initial outlay is the 520, 520. And ROI, return on investment, then return on investment, equal sign, bracket, adjusted cash flow minus the initial outlay of 520, close bracket. You can just leave it like, oh, that is wrong. You're supposed to divide that with the initial outlay again. Then you divide with the initial outlay. So adjusted cash flow over initial outlay minus initial outlay, then divide with initial outlay. Cash flow minus initial outlay over cash flow. I hope I'm not confusing. The cash flow minus initial outlay over initial outlay gives us some 0. If you put that in percentage, it's 19%. Another one, another part, plot a graph. So plot a graph of the project's NPV given the weighted average cost ranging from 1 to 15. So they want us to plot a graph. So plot a graph of, let us get this correct before we plot that graph. Project's NPV profile given the weighted average cost of 1% to 15%. So 1% to 15%. Now what you do here, you bring our values because we want to compute NPV. So get the adjusted cash flows. Up here from 1,000 to the last. Adjusted cash flows over the period. Apart from adjusted cash flows, also bring the total initial outlay. Now the total initial outlay is equal sign negative 520 because it's an outflow, so it's 520. That is the total initial outlay. Total initial outlay. Second or third, we can have the work and NPV. Work and NPV. Work here, then NPV, it's from 1% to 15%. This is equal sign 1 plus 1% again, 1 plus 1%. Don't lock anything. Convert that to percent. Those rates range to 15. Create a schedule that represents the work from 1 to 15 and another column for NPV. After that, we plot a chart. Net present value will be equal sign. So follow the way we want to lock. Then NPV tab. The rate is 1%, so don't lock this rate. Don't lock this rate. It's 1%, comma. Values, select from 100 to 199. So from 100 all the way to 199. Lock it with absolute cell referencing, F4. Lock that to be constant. So it's locked. You can see the dollar signs, then close bracket, plus the outflow of 520. You add the outflow of 520, enter. The first NPV is 80, then drag down. I'm supposed to lock the other one as well, so double click. Also lock the outflow. It's not supposed to change. The outflow should not change. So lock the outflow, enter, drag down. That becomes our NPV. Showing a graph showing NPV and work. Select the data, insert recommended charts, let me see if I have all charts, maybe column. Okay, column, I think the recommended ones are even column. So just go for the first one. No need of changing. There's also another one. The first one is okay. So different rates and NPV, then click on this. This is the chart showing different NPV and the work. This is just a column chart. Just a column chart. Grid lines, I prefer minor. I also want the axis title. This is rate, work. The other side, NPV. You can see some NPVs are positive while other NPVs are negative. This will be NPV at different levels of work, WSCC. You bring the title. You also bring the x-axis, which is work. The y-axis is NPV. If you want to change the color, which is not necessary, you just pick on another color and move. Now on to the next one. That was number C. We have two more. D, determine the project's IRR. So determine the project's internal rate of return, IRR. That is very easy. We can either do using a chart or formulas. We'll be using a formula in this case. So determine the project's IRR. The project's IRR. Equal sign. Give me the adjusted cash flow. I only want the adjusted cash flow only. That is the project cash flow. Now, after the project's cash flow, they talked of rate. Have we been given a rate? Is not required. In fact, I need, apart from the project cash flow, I need the first one, the outflow. So I've not gotten the outflow, so I'll be looking for the outflow as well. So I want to include the outflow. So we will cut this and paste here. Then I can do Control X and Control V. Bring in the years from 2025 to the last. 2025 to the last, then give me 2024 because we need the outflow as well. 2024 is a negative, so equal sign negative. The outflow is 520. So that's what I need for this. Just call this cash flows, the adjusted cash flows for the period. IRR. IRR. For IRR, you'll need the year's cash flows starting from year 0, the inflow. The inflow should be negative. The outflow, the outflow should appear as a negative. The outflow should appear as a negative. So remember, this was the initial year, the initial period. So it's an outflow. IRR will be equal sign, then IRR. Just select all the values from 520 to the last one. Remember, 520 is negative, so select all of it. From 520 to 199,200, close bracket, enter. And IRR is 5.61. The last part of the question talks about computation of the PI. So PI, you can also be able to get profitability index. Profitability index. Those who did Excel with us, the other part of Excel with us, you can see that there's a lot of application of the knowledge that we gained in advanced Excel, where we were talking about the net present value, the present values, the future values, and some other. Now, when computing profitability index, I'll again need the years together with the adjusted cash flows. But because here, I don't need the outflow to be part of the other one. Just give me 2025, not 2024. So 2025, drag all the way to 2029, and the cash flows are from 100, drag to the last one. Work, that is work. You've been given work as 10% in the question, 10% work. So that is 10%. Work formula for PI, so profitability index is equal to PV of inflows over PV of outflows. The PV of inflows over PV of outflows. Then the PV of inflows, then the PV of outflows. Give me the PV of inflows and also the PV of outflows. The present value of inflows, use the NPV function. So you'll be using the NPV function, but don't add the outflow. So use the NPV function, which will be equal sign NPV. The rate is 10, comma. The values are from 100. The values from 100 to the last one, but don't add the outflow. So you're using the PV, net present value, but don't add the outflow. That will give you 457. Now the outflow is equal sign negative because we have some outflow somewhere, 520, that it comes as a positive figure. So that is the PV of inflows and also PV of outflows. Remember, for outflows, it is at year 0. And if you get the present value interest factor at year 0, it is always 1. Then 1 times the amount, it returns the same amount, which is 520. That therefore tells you that our PI is equal sign 457, divide that with 520. That will be the answer given. 0.88. I hope that completes that, and we get our final answer as 0.88. That is what the examiner required. This will be the PI of 0.88. PI of 0.88. You can check through from what we've done here, the relevant cash flows, the investment in working capital, the salvage values, the after-tax cash flows over the periods, the return on investment. We've plotted a graph. We've plotted a graph of NPVs at different rate of returns. Then at the end of the day, the internal rate of return and also the PI.